Good morning, everyone. My name is Tyler Steinhoff with the Life, Annuity, and Long-Term Care team here at Insurance Advisors Direct, and thank you for joining us. With me, I brought on one of our strategic partners, 𝗁𝗁 𝗁𝗁 from 𝗵𝗁𝗃 Financial. What we're going to do here today is talk about, in a sense, a broad scope of things, but very, very surface level about different tax diversification strategies that you as insurance agents can implement with your clients. We're going to dive into different accounts, how they function, how they work. And then at the end, I'll wrap this up and I'll be giving you guys all a call about a survey that you can present to clients and get feedback from, as well as an incentive program that we're partnering with our agent partners with for just submitting life business throughout the year. So with that, 𝗁, go ahead whenever you're ready.
Well, good morning, everybody. I really appreciate y'all being on this this presentation that I'm going to give today. When you listen to this presentation, I want you to think about this in really two avenues or two different, I guess, routes, right? I call this your route to retirement. I want you to think about this. We're giving you the presentation today so that you can understand and learn the concept and idea behind tax diversification, why it's important, and how to have that discussion with your clients, okay? But I want you also to understand that this presentation here, with the partnership that we have with IAD, this is available for all of you, okay? You can use this and do your own webinars for clients. And I'll tell you, I've been doing this ever since COVID came about, right? COVID happened, lots of webinars started happening, and I'm going to let you all know this webinar gets huge traction, and every time you do it, you will get sales. So however you're prospecting right now, add to your prospecting in the sense that, hey, set up a monthly or set up a bi-weekly webinar that you're trying to recruit people to, right? That you're trying to call people. It's an easy way to invite people to something, to listen to you give an idea wrapped around a real dire issue that we have today in this country. So look at it both those ways on one, learning today about the concepts, but two, how you could use this and prospect to this and invite people to this webinar and present to them. So without further ado, here I go. So your route to retirement, right? Think about it. Planning for retirement really, it's not like a drag race, if you will, right? It doesn't happen wham bam right there. Most individuals plan for retirement like it's a lap around the track rather than truly a cross-country journey. All right. And I don't mean to sound hokey or corny here, but when I put this all together, this is what I was thinking about. So think about when you take a trip that's going to be across the country. What are some of the roadblocks? What are some of the twists and things that you could run into? Because this is what happens in real life when people come to retirement. And I'm here to let you know, every single person you talk to, they're going to come up with some excuse to why they're not able to make changes, to why they're not able to start saving for retirement. The bottom line is those excuses hurt them, not you. But our job as advisors is to make sure they understand that those excuses are not doing anything to help them. So when we think about our route, right? When we think about it, you need to pick your destination and know where you're going, right? Just like retirement, you need to understand, when do you want to retire? How much money do I currently make? What are my expenses? When I understand this and I pick where I want to get to, then I'm able to look and figure out how to start saving to get there, right? Understand, we're not going to be talking today and really digging very deep, like Tyler said. We're going to be talking high level. When we get into this, the more minute or getting into weeds, those are the more conversations that you're going to have with Tyler or your clients are going to have with you. But When you look at the classic scenario, right, of retirement, it's like, hey, where can I go golf every day? Where could I play cards at night, right? Where could I travel to? What can I do? These are the things in retirement, right? People think about moving someplace warm. They think about golfing, traveling, seeing grandkids. Okay. These are the things that we need to know and help our clients understand that once we know this, you're now able to help them, right? So the next stage is once we understand this, we're going to go ahead and map our course. Okay. We're going to consider the things that are going to stand in our way. What are these obstacles, right? And some of them have been around for hundreds of years and some of them are brand new. Okay. Some of these obstacles are the same things that your parents and grandparents had to deal with, but also some of them they did not have to deal with. We're going to go through those. So when we look at mapping our course, right? We got traditional obstacles, we got new obstacles. So when we look at traditional obstacles, what we're going to think about is some of these things that everybody's had to go through for a long time, right? People living longer, market risk, inflation. These obstacles have been around forever, whether people are aware of them or not. They are there. As an advisor, the goal here is to make sure people are aware of this. Remember, one thing that I always say to people when we talk about planning with our clients, understand you are not trying to plan with your clients and discuss products. It's not what you're doing when it comes to what we're talking about here. What you're trying to do is you're trying to, and I know this is a word we all don't like to listen to or hear, but sell, right? We don't want to sell products to people. What we do want to do is make sure that they understand the obstacles. We want to sell the obstacle to them. We want them to understand what those are and what it means to them with being able to get to retirement, right? So the first obstacle that's really been around for a long time is people are living longer, right? When we look at this right here and we think about this, what are we looking at? Well, check this out. A man that's 65 years old, 50 out of 100 of them are living another 24 years. Women, another 25 years. Couples, another 29 years. Let's go to the very bottom here. 5 out of 10 men age 65 are living to the age of 100. Women, 102. Couples, 103. Folks, what's the problem? Well, it's great to live longer as long as we're living healthy and are having fun. But understand, one of the biggest problems with living longer is we need to endure market ups and downs. We need to endure inflation. We need to endure health costs. We need to deal with the possibility of long-term care stays and how that could affect our retirement, what we want to pass on to each other, to our kids, right? Living longer is a huge issue. It means that people need to have more money. And how do you get more money? You make sure that they understand that they need to start saving now. Market risk, right? Check this out. 70s, 80s, 90s, 2000s. We're currently enduring some things right now. Here's the deal. Almost every 10 years, 10 to 15 years, we have dealt with a recession. Okay, we've dealt with a market decline. We've dealt with issues. It's going to continue to happen. Market risk is a real thing. So your clients that you're talking to, they need to understand why diversification, not only within the market, is humongous, but having a fully diversified portfolio to include things outside the market is very, very important. So while we continue to talk about the market, let's talk about something. And this is this is not a concept. This is mathematics, okay? And this could happen to anybody. But what you want to make sure that people understand is this: you could have two different people at the same stage of life that get the same return on their investment, but completely and utterly have different outcomes in retirement, right? So let's consider year one's the year before retirement. Year two's the year of retirement. Year three is the first year that we're fully in retirement. And year four is that subsequent year, right? If we look at scenario one, that year before retirement, this client got a 27% return. Scenario two, they got a negative 15. All I did here was flip the numbers around. But when you look at this, okay, scenario one or person one, their money is going to last an additional 13 years. Or another way of looking at it, person two's money is going to run out 13 years sooner. So what does this mean? When we're looking at inflation, when we're looking at living longer, we need to have more money that lasts longer. People need to diversify. That does not mean that they need to turn around and make sure everything that they have is completely safe, because then you run into the problem of inflation, right? Folks, understand sequence of return is huge. I love this one. Tell you one thing. 1968, a GT convertible cost $3,000. How cool is that? Anyway, the bottom line that you really want to see here is look at the difference in what happened. And a lot of this stuff all correlates with everything. But if you start looking at 2002 to 2019 versus what these cars cost today in 2024, look at the explosion of how much things are going up now. I'm not here to have a political conversation with anybody, but one true fact is this: inflation isn't the only issue we have. Greed, right? Greed is something that's out there, that these things are going up, and we need to make sure our clients understand that. It doesn't matter where you sit. It just matters that you need to understand the game so that you can play it the correct way. So folks, when we look at this, what we are seeing is return risks, right? That can really be a concern for you. But if you turn around and keep all your money under the mattress, you keep it all in a checking and savings, you put it in a money market, right? Well, you're really not going to have potential for growth. That could be just as bad, because now inflation, price gouging, whatever you want to call it, these things come into play, and now you don't have enough money, or you're losing spending power of the money that you have. So we need to make sure that we make really good decisions. And we need to make sure that as advisors, we are selling to our clients these problems: inflation, living longer, right? We need to make sure they understand these things. But once they understand those, we need to make sure that they understand there's also new obstacles, right? The traditional obstacles really been accounting for these for the last 100 years. New obstacles are things that we all have to deal with, that people that aren't retired yet need to deal with. Okay, Social Security uncertainty, diminishing pensions, compounding national debt that's going to cause taxes to go up. So when we start looking at Social Security, they do a thing that they try to maintain this 75-year solvency. Okay, I don't quite understand why they do it that way, and I don't want to get into that. But the bigger issue is this: when you look at a 75-year solvency, some of the last things they've talked about is by the year 2035. Folks, I want you to understand 2035. Sometimes I look at that and it plays games with me. The reason 2035 plays games with me is I can't believe we're already in 2024. I remember when the year 2000 was starting to roll around and all the worries and fears we had about that, right? Shoot, 2035, that's 9 years from now. What are some of the things that they're floating? They're floating an increase, okay, in revenues by an amount equal to a permanent 3.65 percentage point payroll tax rate increase. Folks, they're looking to increase taxes to shore up Social Security. I don't blame them. It's something that needs to be done. They're also talking about a reduction in scheduled benefits, right? They're talking about lowering those benefits by 23%. 23%. Imagine having $1 million in the market when you retire. And now what happens is every year you lose 23% of it. Okay? Folks, these two things right here, I don't know what's going to happen. The better bet is probably a combination, but here's the reason you want to know about this, and here's what you want to sell to your clients, okay? You want to make sure they understand the time is now, right? Time is your friend. But hey, listen, wouldn't you want to start saving some extra money now before they start taking more money out in taxes, possibly in 2035 of each paycheck you get? Wouldn't you like right now as an advisor to tell your client, hey, look, let's start taking some money so we could start saving it and get ahead of this ball game that they might start taking more taxes or they might lower benefits by 23%. The only thing we could do is we could control ourselves and we could give the information to our clients and sell them on that. Make sure they understand what those issues are. When they understand those issues, you might now be able to get them to start giving you $50, $100 a month. It's better than nothing. It gets it going. Remember, folks, make them a client, right? Give them what they want, but go back then and make sure you build upon it, right? Check this out. You know, it's not news for everybody, but Social Security really is probably not going to be the lifeline that it was for previous generations, right? A little bit of info here. Program started in 35, was originally a lump sum payment that only covered the primary worker. 1940, only 54% of working age men would make it to the age of 65. Here's the problem. We're living longer. Social Security, when it was developed and everything, they thought it was only going to be able to take care of people till 65. Here's the deal. By the turn of the century, it was closer to 75%, right? That make it to 65. That put a lot of strain on the program. But then we had an increase in people, right? And then we had people starting to live longer. And then we had all these compounding issues, right? Money being taken out of it, the whole thing. But the bottom line is this, is Social Security is in dire straits. I don't believe it's going to go away, but we are going to have a combination that's going to come in to change the benefits. Pensions, I'm going to tell you, I came in this business in 1998, right, with our stat right here. I saw lots of people who had pensions. 50% of employers still offered pension plans in 1998. Today, you don't hardly see anybody. Okay? It is what it is. It is what it is. Pensions are difficult for employers to maintain and do. They're expensive. But that's the thing, where the pension in the past, along with Social Security, allowed people to live through retirement with stable incomes. It's just not that way anymore. We got to make sure people understand that. Okay? But on top of all that, we have another issue, right? Winston Churchill, he made this comment, for a nation to try to tax itself into prosperity is like a man standing in a bucket trying to lift himself up by the handle. It's a tough thing. It's hard, right? You got to have a combination of everything. But here's what I'm really going with, right? What I believe when I put this together, through all the research and different people I've listened to, heard, stuff I've read, the biggest obstacle you all are going to have and that your clients are going to have in retirement is going to be taxes. Okay? Taxes. We're $37 trillion in debt. I say 23. I haven't changed this. You want to know why I haven't changed this? I put this together when COVID hit. What was that? Was that 4 years ago? 3 years ago, 4 years ago, whatever it was, we were $23 trillion in debt just 4 years ago. Today, it's $37 trillion in 4 years. What is that? $14 trillion that's been added to the national debt, folks. It's incredible, incredible. Interest goes up by anywhere from like $5,000 to $6,000 per second on our national debt. Here's the deal, and my numbers are off, but the point is this: more than $70,000 of debt per living citizen, but on average, we only collect $17,000. Makes sense, right? Shows what's going on and what the problem is. Here's the thing. $1 trillion. I want to try to get you to grasp this, okay? So if you look at just 1 trillion, right? Figure out how much a trillion weighs. I want you to get this. A $1 bill weighs about a gram. If you convert that to pounds, right? Convert it to pounds, multiply it by 1 trillion, you're going to see that if you had $1 trillion bills, it's going to weigh 2.2 billion pounds. Okay? Shoot, 2.2 billion pounds for $1 trillion bills? I think 30 pounds that I'm trying to lose right now is a lot of weight to try to lose. 2.2 billion pounds. Think of what that weighs. You know what that weighs? That's the weight of 630,000 mid-size cars. You all are up in Michigan there, around Detroit, where they build lots of cars and do things, right? 630,000 mid-size cars. But check this out. With $1 trillion, you could buy all 630,000 of these mid-size cars 385 times. That's just $1 trillion. We're $37 trillion in debt, right? I got a question for you after I say this, okay? There's really 2 ways to offset debt. You can spend less or tax more. My question to each and every one of you on this call today, and the question that you need to ask your clients, what's more realistic? Do you think it's possible that taxes can go up? Because if you do, your clients need to talk to you. Because what you're going to be able to do is bring a concept to them, bring an idea that's going to be able to help them combat all of these issues, okay? You're going to be able to help them pull together something that helps them retire, all within one product, okay? Check this out. 2018, there's a new tax law that went into place. Lowered tax rates for individuals until 2025 and corporations. But here's the deal. The corporation lowered taxes is not going away. Individuals is going away January 1st, 2025. So again, the brunt of having to deal with this national debt is falling on us, the people, the citizens. Okay? Now, if you're saying to me, we're already getting taxed through the nose, they can't tax us anymore. How are they going to do that? I say to you, look at this chart right here. If you go to the year 1938, roughly, you will notice from 1938 until 1983, I think if I'm looking at this right, till 1983, our top marginal federal income tax rate was right at or above 70%. Many years it was above 80 and above 90. Tell you what was different back then, we didn't have a huge national debt. We had solvency when it came to what they were trying to accomplish with Social Security. But ever since we've gone through as a country and said, hey, we're going to lower taxes, hey, we're going to increase spending at the same time, whether that be on domestic things, whether that be on wars, whether that be on other stuff, the bottom line is our national debt has exploded. And today there's less people in the workforce. They continue to lower taxes. It's an issue that's there. Folks, this is not a political thing. I'm not going there with that. Don't think that. We all want to think that today. The bottom line is it's a fact. It's the truth. It's what it is. And I don't care what side of the aisle you sit on, do not put your head in the sand and say, I'm going to wait for somebody to fix this. You need to tell your clients they need to fix it now. They need to care about themselves and what they can do to fix that, right? Here's the deal. The fastest growing expense in the federal government is interest. This was in 2018. He said within 10 years, we're going to be paying more for interest than on our national defense. This is where I go back. Are they going to spend less? They virtually can't spend less. So what do we do, right? Well, we've gone through and we know where we want to get to, right? We know what our goal is. And as long as we understand what some of the problems are that we need to deal with getting to and through retirement, we're now able to say, hey, how can I put my overall plan together to include the proper products to accomplish what I want, right? And so what I want each of you to think about here is this, is when we look at something called a tax triangle, and I want to let you all know, this gets used across the country by advisors everywhere. The top advisors I work with discuss this with all their clients. Doesn't matter if their client's making $25,000 a year or they're making $250,000 a year. The bottom line is they need to understand the tax triangle so they know how to work within it. So what do we got? We got taxable money, right? Simple taxable money. And this is money that's inside financial vehicles, right? Where you're going to pay the income taxes on the earnings each year. We got tax deferred money, right? Or vehicles, if you will, however you want to say it. But this is money that goes in without being taxed. It grows tax deferred, but when you take it out, it's fully taxed. Let's remember why that's important to know. We're sitting at a certain tax rate today, which we know is going to go up on January 1st, 2026, and most likely going to go up from there even more because there's no other option. And then we got tax-free money. Folks, what you need to do is make sure that you talk to your clients about how you're going to get them above the line, okay? You need to help them understand that they need to have a significant, at least a third of their money should be tax-free. You need to get it above the line. And so how do you do that, right? How do you do that? So again, when you look at taxable money, right, we're talking about stocks, mutual funds, CDs, savings account, your current income. It's all currently taxed, right? Tax deferred money is things like IRAs, 401ks. Maybe you guys work in a school area, 403bs, annuities, 457 plans. Things like this are all tax deferred. When you look at tax-free money, you really have three vehicles, okay? You really have three vehicles that you can use. You have the Roth IRA. This is the sexy one, if you will. It's the sexy one. This is the one a lot of people have heard of. But you need to understand that there are problems with it. For as good as the Roth IRA, there are drawbacks on that, okay? Municipal bonds, right? I'm going to tell you, I've been in this business since 1998, a securities license rep that has worked with people on overall plans, managing money. I have not once in my whole career opened up an account with muni bonds in it. And that's because muni bonds are really for the elite, for those people that are very, very rich, right? The risk versus reward in them is not great. And that's that. So really, we turn around and we're looking at two options, the Roth IRA, and we're looking at cash value life insurance, IULs, whole life plans, these things, okay? And if you're thinking to yourself, which one's better? Don't. They're both good. IULs and whole life, both good. Just depends on your client. So when we start talking about life insurance and how it possibly is better than a Roth IRA, and I hate to use the term better, okay? But, you know, here, when you look at a Roth IRA, you have some drawbacks, right? 99% of all funds in a Roth IRA are invested in the market. Nothing wrong with that. I believe in the market. Just told you guys that. But we need to be diversified, right? And my thought to you is if you have a lot of clients who might already have 401ks or 403bs, 457 plans, they might have brokerage accounts, stocks, different things like this. They already have full exposure to the market. Discuss with them the idea of something that could bring them market-like returns, but does not bring that risk, right? Roth IRA, you got to have your money in there for 5 years and be 59 and a half before you really can touch it without any penalties. And the biggest one is this, is that there's maximums, right? There's maximums that you could put in there. If somebody makes a lot of money, they might make too much money where they can't even have a Roth IRA. Maybe they sit in that sweet spot where they make a lot of money. They're good with their expenses and they could fully fund a Roth IRA. They could put the $7,000 a year in there, but that's all they can do, and they want to do more. This is where our IUL or our life insurance comes into play. You can see it on the screen, right? Tax-free death benefit, self-completing feature. Hey, if your person is 30 years old, if your person's 35, if your person's 40, 45, or 50, these people are still trying to save for retirement. What happens if they died today with no life insurance? Well, the retirement money that them and their spouse are planning on having stops, right? One person, they're now down to one income that they're saving for retirement. Are they going to be able to reach that? Let's say something that's maybe more pressing. Let's say you get disabled and you can't work anymore. Still alive, still need money to retire on, but you can't save any more money because you're not working. The Roth IRA stops, the 401k stops, the 403b stops. It's just going to grow the way it grows. The power of life insurance is self-completing feature. If you get hurt at work or you get injured, you can't work anymore, these plans will continue to grow as if money is being put in them, even though you don't have to do it, right? You're going to get that same tax-deferred growth. What's really cool is you could take out tax-free income via policy loans, living benefits, protection from creditors, no market risk. It's going to give you the upside of the market without the downside. Upside of the market without the downside. You remember one of our problems, two of our problems, market risk, inflation when it comes to retirement, right? This plan allows them to still get solid returns. But the best part about it's the annual reset. This is truly the best. I don't know if I want to call it invention, but it's the best feature in financial planning today. It's the idea that when you put money in an IUL, if you look at this graph, what it's showing you, the black lines, your money going up. Those are segments of 1 year. You can see at the end of year 1, you lock in your gains. At the end of year 2, you lock in your gains. Between year 2 and year 3, okay, between the end of year 2 through year 3, you follow me? Let's say the market goes down. Well, your Roth IRA is going to lose money in theory. Your 401k is going to lose money in theory. Your 403b is going to lose money in theory. Your stocks and mutual funds and ETFs are going to lose money in theory. Here's the thing, in your IUL, you don't lose a penny. Your money stays where it is. See, it's locked in. But what's cool is you now get to earn money from that low spot in the market. Everything resets and you start earning from there. All the rest of your accounts, you have to earn back all your losses before you start earning again. That's not the case with the annual reset on the IUL, right? And this might be a concept that's difficult to visualize here. And again, I know Tyler can help talk that through with you. Make sure that you talk to him about this so that he could explain it to you in further detail. Okay? So, in conclusion, after all of that, right? I have a few questions that we really should look at. Okay? Do you want to rely on the government to get you to and through retirement, right? We're going to rely on them? I'm not talking bad about the government. I'm just going to say the situation we're in, do you or your clients want to rely on Social Security to be that sole or main or cornerstone of the retirement? I don't think so. Think about it this way. Would you rather pay taxes on the seed, right? Would you rather take that bag of seed, pay taxes on that, or would you rather pay taxes on the harvest? Again, if you don't understand this concept, give Tyler a call. He'll explain it to you. The bottom line is this. Would you rather pay taxes today on a couple of bucks? Or would you rather pay taxes in the future on hundreds of dollars? Right? When we break it down. I think it's smarter to at least get a third of your money to help your clients understand how to get a third of their money tax-free. That gives them options in retirement. Last thing that we've always heard about is, can we time the market to protect our assets? No, you can't. You can't do that. Even the best people out there can't do that. So, guys, take yourself out of what I was just trying to teach you and think about the end of this presentation when you're showing a group of people this. You let them know that the first step to moving forward is setting an appointment up. Okay. What I want each of you to know is I really, truly appreciate you being here today to discuss all of this with me. Okay. I really do appreciate that. And if you have any questions now, I would gladly answer any of them with you.
Yeah, thanks, Chris. Please go ahead if you have any questions, put them in chat. We'll leave it a couple minutes open for that, and I'll be calling everyone here after this webinar is concluded. But it's a lot of information. The biggest takeaway that you can take is to sell the obstacle. Taxes going up, sell the obstacle. The products, the case design, all of that, leave that to us as insurance advisors direct, or to me. You know, that's our job in this field. You folks, your job is to educate your clients on everything that was discussed in this presentation, which, if you get enough clients together, we'd be happy to present for you. So far, I don't see any questions, so everyone must be all set here. Again, I'll be calling you all about an incentive program we are running for life business for the remainder of the year, as well as a survey. So expect my call sometime today, this afternoon. And other than that, Chris, thank you so much for hopping on here, presenting this presentation to our agent partners here. And for the agents, thank you guys for taking time out of your
Hey,
schedule to learn.
I want to say one thing before we stop. I'm sorry I just interrupted Tyler. I was scared he was going to shut this down quick. Tyler does have a survey. He said something at the beginning. This survey is designed for each and every one of you when you run your own webinars, or if you want to do this as a seminar. Okay. Again, talk to Tyler. If Tyler, if you don't mind, I have no problem helping with some ideas that that a lot of reps I work with have used in the past to really corner this thing down. But here's the deal. Tyler's going to send you this survey. Okay. Even though it's directed for clients, I'd like each of you to look at that, fill it out, and send it back to Tyler. Right on there if you liked my presentation, please. But more importantly, check on there the spots that maybe you were confused or you feel you want to know more information about. Get that back to Tyler. Okay. So if you could do that, help me get better at my job. Let Tyler know what he could explain to you in further detail. And yeah, you can look to hear from Tyler. So thanks everybody for letting me be here today.
All right. Thank you, guys. Have a great afternoon, everyone.